Hi everyone, this is Jason with Level Up Investing, and I got a slightly different video today. This is going to be a ScreenFlow walkthrough through my MacBook, and I'm going to be talking about PNC Bank. This is a follow-up to a recent video I just did, and if you haven't seen that video, I'll put the link here in the corner. You can go check that out. And in that video, I talk about how Berkshire Hathaway and Warren Buffett, they have sold a lot of stocks over the past few months, and in the last quarter they have not purchased any new positions, but they did expand their position on PNC Bank. So in that video I go over why my theories, my thoughts on why they chose PNC Bank. But after that video, after I posted it, I received some comments about how exactly did you get the intrinsic value? Can you do a walkthrough of that? So I thought that was a great question, and so that's what this video is all about. So let's go right into that. Let's look at my spreadsheet here, my Excel spreadsheet, and let me first give a shout out to another YouTuber who had developed this, and when I saw it, I thought it was really good. I've used several different methods for intrinsic value before, like some other people have commented that they've done. I've used earnings per share and growth rate over the next 10 years. I've used internal rate of return and determined a good stock price to purchase to develop and get that IRR. But all said and done, I have now felt that using discounted cash flows has made the most sense. So I went ahead and found this channel. It is Growing Wealth, and in this channel, the YouTuber here does a really good job, I think, with explaining some key topics when it comes to value investing. He does a lot of videos on options trading. And yesterday morning, Sunday morning here in the U.S., for me, I was able to watch this right here, this live market analysis live stream he did. He went over some stocks and looked at some of the values and some of the numbers, and I thought that was very educational. I learned a lot in it, and so I really enjoyed watching his videos. As you can see, I'm subscribed here and I hit the notification bell. So let me go into the video that is most relevant to this topic, and it is right here under his section on value investing course. He has this video right over here on the right, which is create your own intrinsic value calculator, and or how to make your own intrinsic value calculator. So in that video, he does a real step-by-step approach using Excel, and shows you how to create exactly what I did. I found that by doing it step by step, it took a little while to do, but I found by doing it, I really got a good understanding for the formulas that were used and just how it works. And so I highly recommend watching that video and doing the walkthrough with him and creating your own. So again, I highly recommend his channel, Growing Wealth. So let's go back to the spreadsheet. So this is more or less what the spreadsheet came out to. I did a few modifications on it, but let's start off with on the left here. How do I actually do the intrinsic value calculation? I start off with the operating cash flow from the most recent full year. And so let me show you where I get that. Let me go back to the channel here. Here's the channel, and then here are some of the sites that I use. So I use Guru Focus. I also use FinViz, Zacks, Yahoo Finance, and I've also used a few others in the past, but I find that as I rotate through these, you get the best data. So the first thing is the operating cash flow. So one way to do that on Guru Focus, I go over to the 30-year financials, and I scroll down here. You see the income statements, the balance sheets, the cash flow statement here. So on Guru Focus, they break it up into annuals and quarterly. So right here, cash flow from operations, and I look here to the most recent annual number, which was ending December 2019, which came out to This is in millions, so it came out to 7.363 billion. And so going back to, I also corroborated that with other sites. I also compared that to the 10K. I always like to make sure that the numbers are up to date. I've been on some websites where the numbers have been outdated, so I always like to look at a couple different sites. So cash flow from operations, 7.363. Again, this is in millions. So then the next step is the growth rate. So let me first walk through some of the sites I used. So growth rate, my general focus, my general approach is to take multiple growth rates that were determined by analysts, and I will try to take the most conservative approach, and that is to take the lowest one that makes sense. So let's start off with Guru Focus. If I go back to the top here, I go to summary, and then to the right, work my way down here to the analyst estimates. So the EPS growth rate was 2.00. For FinViz, you scroll down here, and I don't know how many pictures of Bill Gates you need on this site, but nonetheless, here it is. Let's see, growth rate is on the EPS. Next 5 years, 1.59. And looking at Zacks, it gives you the EPS growth rate from years 3 to 5 of 7.00. And then Yahoo Finance, if you scroll all the way down under, just show you where I am, under analysis for PNC Bank, the next 5 years is 1.59. So based on those numbers, 1.59, 1.59, 2.0, and this one was 7.0. So the lowest number out of that is 1.59. So let me point out a couple things right here. I went ahead and used 1.59, again, the lowest number I found. And this is, as you see from the analyst reports. So let me point out that there was a comment from the last video from one of my friends named Family Dinner 1, and he wrote, "I don't really understand the 2% growth rate. That seems so low, doesn't it? Surely, don't call me Shirley, their growth will be higher over the next 5 to 10 years. Yahoo Finance has the growth rate at 1.59%, which is what you just saw." So if you want to take a look at that comment, you can see that on the last video. So first of all, the thing about Shirley, don't call me Shirley. If anyone knows where that came from, then definitely write it down in the comments. That's kind of fun. It's one of the most classic comedy movies of all time. It's up there with Vacation and Galaxy Quest, as far as I'm concerned. Anyway, let's see. So the growth rate of 1.59. So the point is that in this whole intrinsic value calculation, when it comes to the growth rate and the discount rate to some extent, both of these, this is where I feel this is where the most subjectivity, the most bias comes from, because the cash flow from operations, that's a fact. Shares outstanding, that's a fact. But the growth rate, a whole lot of interpretation. So I'm thinking that the analysts are thinking a 2% growth rate, 1.59% growth rate, because of the significant amount of volatility and level of uncertainty with the market, and also depending on what Fed reports they've reviewed. The most recent Fed announcement was that the interest rate, the federal funds rate, was going to stay low for a while, at least a couple years. So that means that the interest for loans is going to stay low, and so the revenue is going to be low. So that doesn't mean that means it's not going to be so good for banks. So that's again, that's all history, that's all story, that's interpretation. So I've just determined, as a retail investor myself, not an institutional investor, not a professional analyst, I've determined that I'm going to take what the analysts have determined, and I'm going to use the most conservative number out of all of the analyst reports, because I think if I come up with my own growth rate, it's going to be, just as subjective, just as biased, if not more so, as opposed to someone who analyzes this stuff all day long, which I don't. So that's my rationale for using the lowest growth rate I can find, and in this case came out to 1.59%. So again, for family dinner one, thanks for the comment. I appreciate that. So the growth rate for the following 5 years, what do I generally do here? I do agree with the idea that if it's a growth stock and the anticipation is that the growth rate is really high for the next 5 years, let's say 20 to 25%, that's really high. That the anticipation is that the following 5 years that a company will likely not be able to sustain that for the whole 10 years, and that's going to drop off. So 15% has been a common number used as the final 5 years as the cap for that. Well, that doesn't really apply here because the growth rate is so low. Again, I'm taking the most conservative approach. If my number was above 15, then my growth rate from year 6 to 10 would definitely be no more than 15. But in this case, it's just going to be the same for the next 10 years. Again, very conservative, I think. The next is the discount rate. And so someone else also asked, how do I get that? So this is the chart. This is how I determine that. So the discount rate, I've also seen in numerous analysts and experts, I've seen the numbers of discount rate of 5 to 9% being a safe margin, a safe range to use. So this is the range that's used in this chart here, from 5% to 9%, and then it's broken up by the beta, which is a measure of the volatility of the stock. So going back to the other screen, looking at Guru Focus, I look at the betas, and this beta is 1.41. Essentially, any beta above 1.0 would be considered rather volatile. So 1.41. Let's see, on FinViz, the beta is 1.28. Zacks says 1.29. And going back to Yahoo Finance, if you go back to the summary, it has a beta of 1.28. So 1.28, 1.29, 1.28, and 1.41. So as opposed to the growth rate estimate, where I'll use the lowest one as most conservative, for the discount rate, I will use the highest beta that I can find, and in this case was 1.41. That's assuming the highest volatility, which to me allows me to have a more conservative approach, because as you see, as the beta goes up, the discount rate goes up. So in this case, 1.41 would have a discount rate of 8.5%, which is what I used. The 8.5% is really it's allowing me to take the cash flows from that recent year, applying the growth rate, and then scaling back using the discount rate to try to find out what that cash flow is worth in today's dollars, using a discount rate that takes into account the potential for error in the growth rate. It gives me a little margin of safety, and the higher the discount rate, the more conservative it is. So again, it's being very conservative. So another thing I want to point out is in the most recent video, I actually stated numbers for the growth rate of 2% and the discount rate of 9%. I actually did that as more kind of shorthand, but my calculations were based on, and are still based on, these actual numbers, 1.59 and 8.5, in case you were wondering. So the shares outstanding is the last number I have here, and I can find that pretty easily under Guru Focus. Again, on the right here, shares outstanding in millions, 424.26 million. So I put that in here. So now let's go into the actual calculations. So this is it here, and this is the formula. So net present value. What are the cash flow numbers in the future going to be worth in today's dollars? So the way to determine that is taking the calculation is the value, which is the net cash flow occurs at the end of each period one. For example, year one, what is the projected cash flow? Divide that by 1 plus the discount rate, which is the discount rate used to discount the cash flow. So that's our discount rate number. So for year one, I'm looking at the cash flow anticipated, which takes into account the growth rate for that year, and I'm going to divide by 1 plus the discount rate for that year. And this right here is the sigma, and if you remember back in algebra, sigma, the uppercase sigma here stands for summation. So you take this one for year one, and then you do it again for year two, then you add those two together, then you do it again for year three, and then you tack that on, and you keep adding them all up until you get to your time period, which is N, the time period of the project, which in this case is 10 years. So here it is in chart form. And so the projected cash flow for year one is 7480.07. How did I get that? So this is for all the Excel geeks out there, like me, and wannabe geek actually. Anyway, so how does that number get determined? I always like to know what's behind the curtain here. So what is this? This is the B2, which is the cash flow from the last year. Multiply that by 1 plus the growth rate. So it is this number, 7363 times 1.0159, and that will give me the anticipated cash flow at the end of year one. So that makes sense. 7363 becomes 7480.07 for that, and then you take that number and then you multiply that by the growth rate. So here you go. You take the F3, which is that number, and you multiply that again by the growth rate of 1 plus the growth rate. So it's 1.0159. And you keep doing that all the way until you get to the end here. So you have that for 10 years. Then from there, you take the discount rate, and that's where the formula comes in. Again, the discount rate is actually that bottom, that 1 plus the discount rate is what's going to be added here. And from there, looking at the formula, you take the value, which is this, which we said that in the formula, the value here, and then you divide it. So F3 divided by G3. So F3 divided by G3, which is again 1 plus the discount rate. So the value over 1 plus the discount rate, and that comes out to this number. And then you sigma all of those for 10 years, and then you get the final sigma, the final sum. So from there, this is what we're saying is that if we have bought into this growth rate and discount rate, then after 10 years, this stock is going to generate 52,191.65 actually 52.19165 billion operating cash flow added all up over the next 10 years. You take that whole number, and that's the present value. You take that whole number and you divide it by the shares outstanding, and that gives you the intrinsic value. So again, H13 divided by B6, so H13, which is this, divided by B6, which is this, comes out to the intrinsic value per share is now $123.02, and that's what I came up with and what I stated in the last video. So from there, I even have a little line here, 50% margin of safety, basically that cut in half. If I was feeling very value investing in that mindset, then I would wait for this price if I really wanted a 50% margin of safety. But nonetheless, you take this number and then you compare that to the current stock price. This was the current price as of the time of the last video, which was $110.76, and you compare those two, and that tells you that the stock is on sale at a discount of 10% compared to the intrinsic value. I like to put in the evaluation date, and that way I can adjust this as we move forward. So that's how I determine the intrinsic value for PNC, and how I determine that it is at a 10% discount. Keep in mind that the intrinsic value calculation is only part of my whole evaluation. You can see the broader evaluation in the last video. So if you like this content, definitely give a like for this video, and definitely subscribe so that you can see videos as they come up. I'm going to be doing a new video pretty soon here, which I'm calling being smart or dumb in the stock market. So if that piques your interest, definitely subscribe and hit the notification bell so you'll see that video as soon as it comes out. So hope you like the video, and I'll see you on the next one.